showing.
Let's do
We're
it.
recording.
Three.
We're already
Three,
recording. You
one.
don't have to count down. Yeah.
5,
I fooled you today.
4. Hit
No
it.
countdown necessary. We are rolling. Good morning. It is February 17th. Monday, February 17th, 2025.
Happy President's Day.
Happy President's Day. The market is closed today. No market activity today. Nice little break from the norm. Anywho, welcome to Momentum Monday. This is a podcast where we have a recap of last week's market performance and we look ahead to a couple of key economic events and talk about some specific happenings and goings on. So I'll let you jump into the fine print first and then we'll get started.
Yeah, before we dive in, reminder, all information shared during this podcast is for educational purposes only and should not be considered as financial advice. Always consult with a financial advisor before making investment decisions.
Okay, so this is a good point. This brings up a good point because little show note, we are now officially on audio platforms for this podcast. This is not just a video podcast anymore.
Oh, so
we
you
are
can't
on,
put the disclosure up.
Well, I can for the people that are watching it, but for the people who are not watching it, you're going to have to be a little more, they're going to have to slow you down to like half a speed or whatever. But yes, we are on Spotify and Apple Podcast platform, most of the platforms where you can get podcasts. I'll show the album artwork here, and just look for the blue that Momentum Wealth, Momentum Mondays, and that's on all of your favorite audio podcast platforms, and it should go out at the same time it goes to the YouTube platform. So
yeah, no, I mean, 80% of the podcast is for existing clients. It's for us to always be in your ear, in your inbox, providing you insight into how we're, processing things that are happening in the news and things that are affecting your retirement accounts, et cetera, et cetera. But if you're one of the ones listening that are not a client, keep in mind that this is for educational and informational purposes, and always reach out to us or your financial advisor, which you really shouldn't have another one other than us. So momentumwealth.us, schedule a call. I'll be more than happy to talk to you about your portfolio.
All right. So, let's get into it. I've got a little message here on my thing. So let me take care of this. Pop-ups all over the place. All right, so let's jump into the week that was, the week of the 10th, February 10th. We had the S&P up 1.49%, NASDAQ up 2.9%, Dow Jones up 0.60%. Russell was actually flat. It was down 0.01%. And then you had, looking at commodities, you have gold up 0.91%, silver up 0.96%, 10-year bond up 0.19%, and Bitcoin was actually flat on the week. So that was interesting. We had a little bit of some interesting conversation around gold happened last week because there was one day, I think Thursday or Friday, where gold just dropped off a cliff somehow. It's had a good run so far this year, so has silver, but they both sort of took a fall on, must have been Friday. Yeah, the 14th, it was Friday. It was down quite a bit. So there's a lot of kind of scratching of the heads and pontification on why that might have happened. And there's some concern around the physical stock of gold. Now we've talked about DOGE last week, the Department of Government Efficiency, and this week it looks like I don't know if it'll be this week, but it looks like they're eyeing an audit of the Fed and an audit of potentially gold reserves the Fed is supposed to have. And
yeah, because the U.S. Treasury still, and we spoke about this a couple of times, it's very interesting, but the U.S. Treasury owns half a trillion with a T dollars worth of bullion still that
it's not valued at $500 billion.
No, that FDR essentially confiscated from the American people. I mean, it's just history. It is what it is. You go back and you read about it. It seems very totalitarian, but then when you understand the things that were going on in the background, it may have saved that current.
My God,
it may have. You're supposed to set it on Do Not Disturb.
You can do that.
It,
all right,
it may have saved. Right,
set it on Do Not Disturb.
I can't do it.
Yeah, you can from your computer.
It'll control the phone too.
Yes, it will, because they're connected. The profiles are connected.
How do you do it? Focus.
You go up to the
Do Not Disturb.
There you go.
For 1 hour.
For 1 hour. All right. Sorry about that. We will punish Matt accordingly.
Well, what I was saying is that, in all likelihood, helped save the country that was going through the Great Depression at the time. But the U.S. government still has all that gold, allegedly, and the Fed holds that. So it's not the Fed's gold, really. It's the U.S. Treasury's
Right.
gold.
This isn't
So,
a U.S. specific phenomenon, though. There are a lot of other countries that are supposed to hold gold as well, and there are doubts cast upon how much they have, how much of what they say they have do they actually have. So this is like a whole kind of, I don't know, you call this like a conspiracy or something,
well, no, I
but
mean
it's
it's like what happened with. Well, I wouldn't talk about I guess the collateralized debt obligations of the banks back in 2008. But when you have a commodity or an asset that doesn't move its location or actual custody, and you're just putting paper ownership on top of it, and leverage is always involved, you can have 10 people have a claim on one bar of gold vis-a-vis the ETFs or some other type of mechanism. So yeah, it's always been a question: do where's the gold? Where's the gold actually
where's the
at?
gold?
Yeah, where's the gold? So that would be great to see. And Doge.gov, and I think this is for those that are following, because it is this the Doge what the Doge group is doing is going to have a significant impact on the U.S. government's ability to not run a budget deficit this year. So if we have any hope for that, which if you want inflation to go down, you want to see a budget surplus, not a budget deficit, because that's one of the fastest ways to accomplish that. And we saw that happen during the 90s. A lot of old clips going around of what was called the RIGO, RIGO, which was Al Gore was the leader, and him and Bill Clinton, but Al Gore was spearheading this movement to improve government efficiency. They cut 16% of the entire federal workforce over 8 years, and they created, along with many other things, a budget surplus for the first time since, I think, Calvin Coolidge.
Yeah.
So that's going back to the 20s. So you can go to doge.gov and follow a lot of what's being tracked here. And I would encourage you, because there is a lot of misinformation. I fell prey to it as well. A lot of reports that were saying celebrities were paid to go to Ukraine, to show support. That was not true. They weren't actually.
Really?
Yeah, that's false, negative, fake news.
Interesting.
Fake news. So they've got the website up and going now. I think it on Valentine's Day it happened, and then you can go into.
Well, there's also
the receipts aren't up yet, but you can track what's happening here. So it would be very interesting to see an audit. I know that several politicians over time have talked about, the importance of a gold standard. First, you got to even know what kind of gold is there before you could even try to
Yep.
create any type of tethering of any financial instrument, even if it's U.S. Treasuries to gold, that's the most realistic thing. If you're going to go to a gold standard, the most realistic path would be to issue just a small amount of treasuries whose interest is payable in gold on demand if you want it. And so that would create an anchor mechanism, and that would give the federal government a little bit more control over long-term interest rates, because the Federal Reserve really has no control over long-term interest rates aside from quantitative easing. And even that is questionable as to whether or not it's effective. But CPI, I guess that's where we're going with this.
Sure. Yeah. We had CPI numbers come in hot last week, a little hot, hotter than expected, which led to some kind of volatility in the market. So, the core inflation rose a little bit year over year, or month over month, rather. But it's kind of in
Both year over
line,
year and month over month.
in line with previous increases, which would suggest maybe that it's sort of stabilizing or moderating itself. But there was a lot of talk about the neutral rate too. It's one of the things that I kind of brought up. There was a post from Nick. I'm going to figure out how to say his name.
Timorous.
He comes up a lot on here.
Timorous.
Timorous. Nick Timorous. It's the Wall Street Journal reporter that reports a lot about the Federal Reserve. All right. Yes. So we had to pause, but we're back. So picking up from the neutral rate. So we had Nick Timorous from the Wall Street Journal give some commentary from Jay Powell, who's the Federal Reserve chairman, that his idea of the neutral rate being very clearly low before the pandemic, and it's likely that after all of this, the neutral rate will have risen meaningfully. And so our consensus is that we have to assume that he's okay with some sort of higher rate than what they have been saying for like a year now, which is 2%. And they're harping on this 2%, 2%, 2%. Everybody's heard of this. So now that he's kind of acknowledging that maybe it's not going to be 2%, maybe it's higher than that, I think that's a positive sign. I think it's constructive because, again, to your point, it's a difficult thing to say what the neutral rate is. But, then you have on the other side Trump, who wants the neutral rate at 0, which I don't think is necessarily a great idea either. So
Yeah.
there's like a happy medium here where you have to kind of figure out what the best case scenario is.
I just think the problem is that, generally speaking, I know we had to take a break, so I'm not sure exactly if I said this before, but the Fed never admits what the proper neutral rate is until after they break something. And I mean, that's just the nature of the Fed. They're always right in retrospect.
Yes, but the Federal Reserve, when they break something, what do they break? There's a handful of things that it could be, but
the neutral rate would be what amount of restriction, cost
Right.
of money,
right.
has a neutral impact on business and personal expenditures and just business activity in general, economic activity. It has long been assumed that 2% inflation was a net positive for the economy. You have gentle monetary expansion over time. You have the inflating away of long-term debt over time. And then you would say, okay, well, if 2% inflation is targeted, what type of interest rate do we need to produce that outcome?
Right.
So, and I think the 2%, they that was copied after New Zealand in the late 90s came up, and they had a big study and they thought that 2% should be what world banks adopt. They adopted it, but really it goes back to Milton Friedman, who said simply replace the Fed with a computer that produces 2% more money every single year, and the interest rate is 2% if you borrow money. And you don't even need the 10,000 PhDs that work at the Fed to,
he's getting a lot of airtime lately. Milton Friedman with all the Doge stuff. I've seen a lot of clips of him floating around.
He's dead.
Well, I know, but he's got a lot of video out there on the internet where he's talking about posthumously.
Yeah, attention he's gotten.
So there's a video where somebody's like reading through a list of federal agencies and saying whether he would cut them or fund them. And they read through this list and he's just sitting back in a chair and he's like, cut, 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 cut. You don't need this department. You don't need this department. He's making his case. He's an interesting guy. He's got some interesting.
He's the first monetarist. He's the one that basically created the economic outlook of monetarism, which is purely if you want to somehow fashion better outcomes in the economy without having a command and control environment of price controls vis-a-vis interest rates, which is what the Federal Reserve Open Market Committee does, then you focus purely on the money supply. And it's very interesting. But I think that long term, and this is why we're always, so bullish long term on risk assets, or at least one of the reasons I am, is because no matter what the Federal Reserve does, when you have technology that's improving at a rate that we've never seen, history shows that there's really that no amount of money the Fed can print can stop the natural gravitational pull of interest rates and of inflation downward because of the improvements of technology.
I don't know about that. How I feel about that. I think that obviously the rates that you have to settle on they have to do a lot of things. To your point, they have to create business incentives to grow the economy, but they also have to allow for, when we have 0% interest rates, the government just tends to rack up a lot of debt that then, we're in this situation where we have our debt coming due and the interest rates are higher. All these bonds are about to roll over into 3 and 4% bonds that were 0% bonds. So it's time to pay the piper.
Oh God,
so
it's a 4,000% increase on interest expenditure.
So it has to be a happy medium. You have to figure out kind of a common ground there of how that works. And one of the reasons why there's sort of a push toward risk assets when you have 0% interest rates is because where are you going to get growth? Like you can't go to a savings account and get growth. And so when you saw the interest rates climb up, I think what was the highest interest on these savings accounts that we see? 5.7. Was it, did it hit 6 ever?
Mm-mm.
It was like over 5.5, I think, at the height. So it's just interesting. The whole conversation around that's interesting. But I thought particularly that he was, the fact that Jay Powell is clearly looking at maybe having an open mind here was an interesting thing. But, um, you
Well,
know,
I would just say back to because this goes into what the neutral rate is and all of this pontificating. And there are truths when you look at the process of how the Federal Reserve creates monetary policy. There are objective truths that you can see what their actions have done and what their actions are most likely to do. But all I'm saying when it comes to technology, all that is just like, it's just imagine, a nursing home full of people talking about the weather. It's just irrelevant to what actually happens tomorrow, to what the outcome of the weather is actually going to be. People are just talking about what's happened yesterday, what the forecasters are saying will happen. But at the end of the day, I'm just thinking, people sitting around talking. I don't know. I'm just trying to create an example. But when you look at real world examples of how technology decreases prices and
right,
produces
it's deflationary. Generally.
Yes, but you cannot have deflation in a fiat based or a debt based economic system. That you can't. It is the end of all ends if that happens. So that's why I'm saying that no matter what they say the neutral rate is, they will do everything possible to produce some rate of inflation because you have to have that. And they're battling significant technological shifts that are going to be tremendously deflationary. So we could end up in a situation
over longer periods of time. It's not, 11% inflation in 24 months.
No, I mean, because that was created in Washington D.C. What happened from COVID till now was not some phenomenon of naturally occurring inflationary pressures such as demographic changes. That was purely created by government spending. But when you take that out of the equation, I think the neutral rate over time is going to get back to what it was pre-COVID. It may take 10 years, but I think they're going to have to, because you're having cost per mile driven with electrification is going to drop to
free. That's all longer term. Because if you look at the better example is televisions. We were looking at those the other day.
Right, yeah.
Because we're trying to find a television to put in the background here like we had before in the other set. And you can buy 50, 60, 70-inch TV for less than $500. And so that was not the case, a decade ago. Or
think about online shopping.
7-8 years ago.
Low overhead, dynamic pricing, able to undercut your brick and mortar competition. And so you can sell your products for less. That is deflationary. Now, what also happens, commercial real estate, the malls, the commercial real estate investors can't find people to go into their locations in the malls. They're going to end up losing that to the bank. When there is bankruptcy and foreclosure, that is deflationary. So you have this entire ripple effect that occurs when there's a seismic shift in how people spend their money. And if it's driven by technology, that generally means you get greater value. So we cannot win for losing today.
So you saw, it gets stopped. So the other thing, I don't even know what we were saying. So we'll move on to the next section, but retail sales was a big thing, declining retail sales.
That's right. Yeah.
But the explanation there, I mean, we had December. That's what was before, right? January. So what happens in December with retail sales?
Oh yeah, it goes up tremendously.
Everybody buys. Yeah. And so I think there's a natural expectation that would come in a little cooler in everybody's got their New Year's resolutions, and your New Year's resolution is like, I'm going to go to the gym, I'm going to work out, I'm going to spend less money, I'm going to save more money, so forth and so on. And so I think that's not super concerning.
And we have here so the core PPI, when there's so many layers, all this inflation stuff. So you had the CPI come in hotter than expected. You had PPI come in hotter than expected, but then you strip out energy and food of the PPI, which is the producer's price index, which is the purchasing managers, all these large companies, what they're buying for inventory to get ready to sell, did come in softer than expected. and you take that on the back of, well, if at Christmas, did these companies have way more inventory and they still have so much in the warehouses still, even after everybody spent? Because I thought that was wasn't that a record breaking
It was a
Christmas
lot of spending, yeah.
that took place? So it's very interesting. And I just don't think I think it's presenting the market, which is why we're like 3 weeks now with the market basically ending back exactly where it was week after week.
Yeah.
And I think that all of this economic data is painting a very opaque picture, which is why you can't simply take one headline and make a retirement plan or make an investment strategy with it, because you really don't get the full picture of what's going on until months and months and months have passed. And by then you've already missed out. You've already missed out on, having the right portfolio set up, knowing whether or not you should be in bonds or should not be in bonds. And you can't change your strategy around this. But it is interesting to look at. But I would say right now, probably the fuzziness of the data is just showing us what we already know, which is you have structural change happening in Washington and around the world.
A lot of real estate coming up for sale.
I saw that. And now's the time to get a good deal on a house in Washington, D.C. Also, did you see the criminal defense attorney search?
Yeah.
And Swiss bank account search?
Yeah.
Have shot up like 1,000%.
Rico and stuff like that. Yeah.
It's funny.
Crazy.
Yeah, live by the sword, die by it. So all that being said, right now, I think the data is just reinforcing what we already know, which is we're in a shift and a change of the inflation regime, monetary policy, and fiscal spending. And it's going to take some time before we really get a feel for how that's going to affect the market. I'm biased towards thinking that it's going to be a net positive for risk assets, but just time is going to tell. And that's really in the short term, because I think in the long run, it's very easy. You could, in the long run, you can easily see what's going to happen.
Well, I think definitely all of the bullish things or all of the bearish rather, examples that people are coming up with in the market so far continue to fail, which is very good for the bulls and very good for forward growth of the stock market and the economy really overall. But there's always going to be those people out there ringing the bell and ringing the alarms, and do you have your exit plan ready, and so forth and so on. And there's going to be a time for that.
CNBC has to sell ads. They need people to click on the stories. And you're seeing the same thing with, the new media, which is, X and all these different platforms.
What's another platform?
I'm thinking, well, Facebook is they're uncensoring stuff now.
Yeah.
Is really destroying the business model of the legacy media, which is why you're seeing so much hysteria, because they need eyeballs to sell ads or they're going to go bankrupt.
And their funding just got cut from USAID.
That's true. It really did. And, so that's why we're always a big proponent of tuning out the noise when you're sitting down with us to design an income strategy or figure out which portfolio is right for you and how you can weather the ups and downs to, at the end of that part of your financial life cycle, be better off than you are now. You can't factor in all of this hysteria, because the media, it is month after month after month. There's this new, and this happens when we get to all-time highs too. I
think Facebook plays a large part of that, actually. And I don't know that maybe Twitter does to a certain extent, but Facebook certainly does. We get a lot of clients who get involved in scams and webinars from people wanting to sell you things. And those are all over Facebook. Or crypto scams is really it. We saw a guy a week or so ago that was going to invest in a crypto scam through Facebook, through somebody that was supposedly an investment guru. So you just got to keep aware of that stuff. The general rule of thumb is if it's too good to be true, it probably is.
Just call us.
Yeah. And they may show you the stuff on the paper. They may send you a link to look at on the internet. The numbers aren't real.
We have to talk about. We have to give.
I think we have talked about it before.
I don't know if we gave. So we got a phone call from a client whose coworker, and this is a fairly high up position and very intelligent people, top secret clearance type stuff. And we got a call that this coworker had, turned like, $10,000 into $500,000 in like a week with this trading bot.
Buying and selling certain crypto currencies
Yeah.
that are not really, they're not even currencies, they're tokens. They're
Well, this wasn't even
altcoins.
real. This was fake.
Well,
It
that's
wasn't
what they're
even real
described as.
Yeah.
Yeah. So it's not Bitcoin, it's not Ethereum, it's not, although scams do happen with those
Yeah.
as well. It's particularly the Bitcoin machines that are in gas stations. That is a giant red flag.
Yeah, if somebody asks you to deposit cash in a Bitcoin ATM, do not do it. And if somebody tells you that they can turn 10 grand into $500,000, they can't. Don't do it. You're just going to lose your 10 grand. It's all fake. They're just taking your money. And the scam is, what was the word, the terminology that described that, so people could look that up?
Yeah.
So they can know.
This is something to do with a pig, right? Let me see if I can find
Was it gut the pig or
no,
feed the pig?
Yeah, it's something like that. I've got to scroll back here.
While he's looking for that, just keep in mind, it doesn't cost you anything to have a consultation with us, to just simply call. We'll be more than happy, if we can't answer you immediately, to put you on the calendar today or tomorrow, a 15-minute chat. And if you think that you're falling prey or have a family member that is getting convinced to do anything from a Facebook video or a comment on YouTube,
pig butchering scam,
look that up and call us. And it's free to ask us. And, again, just if it's too good to be true, it is. So you do have to be careful. And I think that Facebook has done a poor job, and so has YouTube, of not stopping the scams. I've seen so many YouTube videos where they're having like Jamie Dimon or Elon Musk, and they'll have the AI talking, and they'll have a QR code. Oh, send 1 Bitcoin and I'll send you 2 back. No.
Well, even on these videos that we post on YouTube, the comments are like, great content. I have a question. I have a wallet here and I'm trying to get money into Bitcoin. Can you help me with this? And those are fake. And I delete those when I see them. But if you see comments like that on these posts, they are not real. They're bots.
Yeah. And if you're on Twitter or you're on Facebook and you get a friend request, if you're, let's just be real. If you're, a 55-year-old man and a 24-year-old blonde Russian girl is trying to Facebook friend you, that's not real. They're going to scam you. And it is most likely, with all due respect to our Filipino brethren, it is most likely somebody in a Filipino call center or an Indian call center that's the same age as you, that's just scamming you. So just be smart out there.
So what will happen generally is they'll ask for a sum of money, $5,000-$10,000, something like that. And then you give that to them and they show you these statements of how it's growing. They'll send you a link to a website that you can sign on to and see the account, the
and the trade
performing and the growth. Yeah.
Yeah.
And then when you go to say, hey, I made $100,000. I want to take some of that out. Can I take some of that out? Then they'll say, sure, we can send it to you, but you got to send us $5,000 to
pay taxes.
Yeah, to pay taxes to get the money. And so you send them another $5,000 and then nothing happens. And you say, where's my money? Well, we actually miscalculated. It's not 5,000. It was actually 10. So we need another 5,000. And this just goes on and on and on and on. And you just pour money into this. You never actually get anything out because it's not real. It's fake. So definitely something to keep in mind. Definitely something to keep in mind if you are a frequenter of Facebook or these other platforms. But yeah, I would say that I can't believe that it hasn't gotten better, because we know they have the tools to censor things they want to censor. And so I don't know why they are not focusing more on something like that that's clearly not beneficial to the majority of their client base.
I mean, not to get into conspiracies, and we really went down the rabbit hole on this, but we know with the last administration, there was choke point 2.0, that you had a lot of people in the administration that was really, and the Federal Reserve, that was really battling against crypto. So anything they could do to delegitimize it, they would do, up to and including letting these platforms scam people so that people would have a negative perception of it.
Yeah.
But speaking of scams, let's talk about Stellantis.
The company as a whole, you mean?
Yeah.
Yeah, that's a good way to segue, I guess. Stellantis in the news last week. Big conversation because Stellantis has introduced full screen pop-up ads in the infotainment systems within the vehicle, promoting services like extended warranties and Sirius XM, things like that. The car that only displays when the car is stopped. So when you're at a red light or something,
it will harass you to play stuff on there. You've already bought the
take
car
over your display. Yes. So Stellantis's explanation for this is that this is something that is coming from Sirius XM, and this is something to do with an agreement that you may or may not have signed with Sirius XM to get satellite radio in the car, and they have the ability to take over these the screen and show these ads. So yes, to your point, you buy a $40,000 or $50,000 Jeep, you get in there, the first red light you stop at, you get an ad for an extended warranty. And the X, I think, on it is very small. And it's very hard to touch on the car when you're driving or when you're stopped. They're too small. My complaint about Tesla, they should make the icons bigger.
Well, it would be fine if they didn't have the nag. So with Tesla full self driving, the car's driving itself, but
Right.
right now they still have it in their system to where there's a camera that's watching you and looking at your face, and you have to have your eyes
Well,
within a certain degree, like this. And so if you're,
that's the supervised part of it. Yeah.
yeah, but if you're looking to hit the X like you're saying, or
Right.
to add a stop, it'll ding you.
Yeah.
Put your hands on the wheel, and it is hard.
Well, even if you're stopped, it's hard to tip over. But the complaint is that it's so frequent. People are getting 3 and 4 ads during like a 15-minute car ride. So, I mean, this is nuts. This is the same thing that you're getting from companies like Amazon, who have Amazon Prime, and they have their Prime channels. And if you pay for that, you used to get ad-free content, and now they're putting content in it. I mean, now they're putting ads in it and saying, we need you to pay $30 a year more to get rid of these ads when you didn't have the ads before. It's just this push to generate money from software services, and this is where companies are going. And there are companies like Apple who are doing a lot of subscription services. They make a lot of money in that space. And so these car companies, and these other companies like that are trying to figure out how to monetize that.
Well, because they're going to go bankrupt. And I've said this numerous times. Your legacy automotive makers, there's the big three. You have Stellantis, GM, and Ford. And I predict by the end of the next decade,
Drumroll.
I would say between 2030 and 2035, because I have an ongoing bet with a client about something similar to this. Between 2030 and 2035, those big three will only be one. Two of them, and most likely will be Ford.
Yeah.
The other two are going to go bankrupt. And I'm going to say, I'll leave myself a little leeway here to say Cadillac could be its own luxury brand.
I think you're going to see that a lot. I think Stellantis is going to be incentivized to spin brands off in an effort to kind of save themselves. But BMW tried something like this a few years ago where they charged for
and this is a family-friendly podcast, so when I have to take a step back as I'm digesting.
I got to find my beat button. I don't even know where it is.
It's this one.
Nope. That's not it.
This one.
Nope. That's not it.
That doesn't work.
There it is. Yeah, our sister button. Anyway, BMW tried something like this a few years ago with heated seats. You had to pay a subscription fee to get your heated seats to work in your car. The backlash was intense, and they immediately gave it up. They stopped it. Stellantis is kind of doubling down on it here. They're getting a lot of flack for it, and they're pushing kind of a lot of the blame to SiriusXM, saying that this is really their kind of deal. But it's your screen. I mean, you built the car. But this is also the problem with these legacy automakers. And we've talked about it before. You heard the CEO of Ford talk about the fact that when they build a car, they have so many partners, they have so many infrastructure components within that vehicle that they do not control, that if they wanted to make a change to, say, the seats or the way the seat moves back, they have like 3 or 4 different companies they have to call. And those companies have to talk to each other to make that change because they don't control any of it themselves. And so I think the closer you get to them doing that, I think Ford is really going to try to correct that in the next 5 to 10 years. And, you even have the Ford CEO talking about, making some comments that may seem like they're pretty open to licensing technology from Tesla. And so that's going to be interesting to see. I think that
this is where I'm going to bring it back to technology creates deflation. And this is the problem. This is an issue. These car companies have both, Tesla is destroying the car companies, and they've sown the seeds of their own destruction. So when you buy a new car from a new car dealership, roughly half of the profit that dealership makes is from maintenance alone, not to mention the sales of warranties, extended warranties. Well, when you have a ultra low cost maintenance vehicle like a Tesla or like a some of the other good EV products that are out there, the one with Rivian,
Rivian.
There is no maintenance cost to speak of.
Well, there's very little,
extremely little. You're talking tires. Maybe even brakes, not so much, because it's
you do have your software issues occasionally.
Well, software doesn't cost much to
Right. But I mean, it's
Split
still a
the
service
update.
issue.
So you have
Well, it can't always be
you
pushed.
Stellantis. You're already you can't compete with the other brands that are out there. If you try to go to electrification, you can't make a profit on the cars. And if you decide to take a loss to sell an EV, now your dealers aren't making any money because there's very little maintenance involved. So what are they trying to do? So you have technology is pushing the price of transportation to almost free in a relative sense compared to what it's replacing, the ICE engines. So as that's happening, they need to make money to stay in business. Subscription services and all this other nonsense that they're doing, instead of trying to innovate and figure out a way to truly compete, the legacy automotive manufacturers are simply just doubling down on stupid. And that's why what the stock's down 50%.
Yeah.
And it's going
over a year.
It's going lower.
45.5% year over year.
What's their ticker?
No, we were talking about this before the show. STLA. I was saying it's very close to Tesla, which is TSL.
Oh, that is true. Yeah. Don't get confused on that.
Don't buy the wrong one. Somehow it always comes back to Tesla.
Still, they're holding a market cap of 40 billion, which is shocking. But yeah, down significantly.
Well, they have so much property. I mean, they have so much IP with the vehicles,
the brands,
the brands that they have. Yeah.
But the PE ratio, actually, it's priced. Oh, good God. It's almost priced at bankruptcy. It's 3. The average price earnings, what in the S&P is 18.
Yeah. I mean, it's not shocking. None of it's shocking with all the problems, but, it's just interesting, something to talk about with where these companies are having to try to push to get money to monetize, which is the subscription services and the software services and all that kind of stuff. So anyway, we'll move on from that, and we have some things coming up this week. Obviously, market is closed today. We have Wednesday housing starts and building permits. Also, we've got the meeting minutes from the Federal Open Markets, Federal Reserve's in thinking on interest rates. Thursday, we got some initial jobless claims, and then Friday we'll have home sales from January and an S&P Global PMI composite flash, which is going to kind of give us indication into
I think
economic growth.
The 30-year mortgage, we may see some changes this week on that, but we're looking at.
You think it'll fall?
It broke the 7 handle already. It's at 687, and from Wednesday to today, the 10-year Treasury, it had a little bump, but now it's the yield's going back down.
Bonds are really at an inflection point, and we went back into bond sectors in January of 2024, right? And so they've just been kind of trading sideways since then. So they got to find an inflection point to go one way or the other.
Which we want. If we want rates to come down, we want bond prices to go up.
Right.
And right now, as we've said, the only way that's probably the only way, aside from some unforeseen economic shock, is for there not to be a budget deficit this year from the Fed, and then you'll see those rates come down. Bond prices will go up, meaning your bond positions will go up in price. They'll rally, which we've been waiting on. We've been positioned for almost a year, and kind of holding steady on our bond sectors. And so we want to see that, because when you're allocated properly in your fixed income portion of your portfolio, you can get stock-like returns in your bond positions. If you're doing it correctly, there is the potential. Now, it's nothing, you're not going to get a 20% most likely, but instead of targeting 4 to 6, it's very possible when we reach these inflection points that you could get 10 to 15% returns on your bond portfolio if you're allocated properly. Which is what we do for our clients in assessing the type of exposure they need to have in their fixed income portion of their portfolio. But yeah, so it's going to be very interesting to see as we walk through this year with our clients and those that are listening. I think that the overall trend is going to be a continued rally in risk assets. I think that it is possible to see a similar return potential like we saw last year. Probably, I wouldn't say maybe as much, but still, if you're in your 401k, if you're properly diversified, I think that it's the potential is there to see somewhere in that low double-digit return again.
Well, yeah.
This year as things unfold, but we'll just have to walk through it with everyone. I think the most exciting thing is, as our firm is really oriented around growth investors. You know, that's where you're going to beat inflation. That's where you're going to be able to produce the proper amount of income in retirement. And what's exciting for us is the current setup for the U.S. economy. Coming out of COVID and getting our spending under control and getting interest rates to the right spot. Our setup is really great. Compared to the rest of the world, the U.S. economy is set up in a really good position. And so I tell our clients that are fortunate enough, they've already gotten where they've survived 2008. They've gone through the taper tantrum of 2013, 2014, the oil price drop in 15, what happened with interest rates in the repo markets at the end of 2018, what happened during COVID, what happened during 2022,
Sure.
you're going on and on. They're really positioned to have survived all those ups and downs. And now, they're really have a higher degree of confidence now than they've had in quite a while in living in retirement and feeling comfortable with the income they're getting from their portfolios. And we're seeing a significant increase in confidence. So always feel free to reach out if you're looking at your 401k, your Roth IRA, your Robinhood account, and you just feel like you need help, that nothing's working. Free consultation. Just reach out and talk to us. Be more than happy to chat with you and see if there's something that we can help you with, if we can add value to a situation. And if not, at least you've gotten a second set of eyes to look at what you're doing.
Yep. Well, I think that wraps it up for us. We'll take it there. One thing I will say is that, again, we'll harp on, we should be getting some more information from the IRS and Social Security Administration about the Social Security Fairness Act. We talked to a client last week who called the Social Security office, and she's going to end up getting like $2,000 a month more than she was expecting to get. So this is a real thing. It's really happening. Make sure you contact the Social Security Administration if you have if you are affected by the windfall elimination provision or the government offset provision.
Yes.
Because the Social Security Fairness Act has recalculated the benefits for both of those groups of people. And it means that you will likely benefit from an increase in those benefits if you are a certain age.
Yeah, and if
Obviously, you
you're
need to be in full retirement.
We had one client thinking that, okay, well, I was a teacher, I never paid into Social Security.
Right.
That doesn't apply to me. No. It absolutely does because of the spousal benefits or survivor benefits.
Yep.
Yeah, absolutely.
Yeah, very important. So definitely contact those guys. Reach out to us if you have any questions about that. But yeah, that's it for us. We thanks for tuning in. Don't forget to subscribe, like, leave a review,
and have a good day. Just wanted to see if it worked.
All right. Well,
it does.
Tune in next week. We'll see you guys later.
Take care.
Goodbye.